Hey everyone, Tyler from Equities Lab, and today we're going to be answering the question, what exactly is the Montier C Score? At its core, the Montier C Score is simply a formula comprised of 6 different variables to assess the probability that a company is cooking its books. It kind of acts like the Benesch score in that way. On the screen, you'll see the formula that we built around the Montier C Score. Now, this score was originally built for one of our institutional clients, but after giving him some time of using it, we've decided to release it to all of our subscribers. How exactly is the C Score built? What are each of these lines and what do they mean? So, firstly, the very first line, we want to look for a growing difference in net income and cash flow from operations. If cash flow isn't increasing, but earnings are shooting up, there may be a problem in how those calculations are happening, putting a little bit more towards some fishy behavior going on in the books. Now, if the accounts receivables are growing faster than sales is another big one. There are ways this can happen without cooking the books, but it's not that often. More or less, if you are inflating your accounts receivable and not selling more items, something is going wrong within either your accounting procedure or how you're selling things, or just you're making your company look better than it really is. And a huge increase in inventory. Inventory itself isn't bad. Lots of companies are growing incredibly rapidly and need to purchase new inventory. That's why this score is based on 6 different elements and not just one. That being said, a lot of companies kind of have a set amount that they're selling each quarter. And if the inventory on hand changes by a considerable factor, it increases, and the company isn't growing incredibly quickly, there's a good chance they're just not able to sell their existing inventory and are still spending money on bringing in that standard order every quarter. The next line, increasing the current asset to revenue ratio. Since investors care about how much money a company is bringing in and how long they're keeping their inventory in stock, some accountants will kind of use this line item to adjust the outlook of the company. It works really, really well as kind of a catch-all for the balance sheet. This is great for the accountants, this is great for the company, but it's really bad for the individual investor. Their balance sheets are going to be skewed in favor of the company, which may reflect badly on you and may reflect badly on their share price, leaving you holding the bag. Another line item that kind of works like that is where they're decreasing the depreciation of the company's hard assets and equipment. So when you first buy equipment in accounting, you set how long that equipment's going to last for, and you set a depreciation value. These values are completely set in estimates, and estimating is an accountant's best friend because you can really estimate it however you want. Say a computer is worth $1,000, and originally the accountant had a depreciation value of $250 a year, and the computer is, quote, worthless in 4 years. Well, in order to make that loss look a little bit less, they can go ahead and decide, you know what, the computer is only going to depreciate $50 per year, and it has an effective life of X. And they can adjust all these values, which make their balance sheet look great. But none of it is set in real hard fact. It's just estimates. And that is what's dangerous, and that is what's scary, and that is what this formula is looking for. Finally, if there is a high increase in asset acquisition, again, these are subject to estimates. If you're buying assets, you get to project how much those assets are going to return. So, say the new 2017 year is about to happen, and I need to make my balance sheet look like I'm going to bring in more revenue over the next year. I'm going to go ahead and buy a bunch of assets that may or may not make me money for the company. And then project that they're all going to be winners and maybe over project, and it's just kind of iffy. That's why we have, if that total asset growth within 1 year is greater than 20%, because that means they're buying a huge chunk of assets within that time span, and that is another way, based on estimates, that you are not going to be able to really trust what's on that balance sheet. Thankfully for you, the Montier C Score goes through and finds companies that fit this bill and then helps you not invest in them. Let's go ahead and check and see how well this does within a strategy and build its own screener. So we're going to head over here to stock screener. We're going to quickly build a screener, and we're just going to import the Montier C Score. and we are going to look for a score of less than 3. So the lower the score, the better. And we are going to press go. It's going to give us all the companies that fit. So there are 3,024 companies that have a Monte RC score of less than 3. So there's a low probability that any of these companies are cooking their books. How well does the strategy do, say, over the past 4 years, since January 1st, 2012? Not too bad, surprisingly. So the only thing that we have in there is that the Monte RC score is less than 3. We have a huge data set of companies, and we can drill this down by adding more parameters to the screen. But right now, I'm just trying to show you the effectiveness of the Monte RC score. You make money most every year. You have a nice low standard deviation, and you almost make as much as the market by only deciding the Monte RC score. Now, what's on the flip side? How well does a Monte RC score do if you're looking for above 3? So these are companies that are a little more iffy. As you can see, you do worse. Not a lot worse, but you do worse. All right, now one last thing. Let's look at companies that have greater than a 4 and see how well that does. And as you can see, if a company has a really high C score, the probability that it's going to make money is incredibly low. This strategy actually lost just about every single year since 2012. It only made money back in 2012, and it didn't make a lot. Every other year, it dropped significantly, anywhere from 5 to 25%. And honestly, I want to stay away from companies that have a high Monte RC score, and so do you. That's why I'm making this video. That's why I wrote an article on it. You can actually find that article in the description below. And why I want you all to be aware of the dangers of estimates and the dangers of companies in the stock market. Just because a company is publicly traded doesn't mean they're following all the laws. It doesn't mean that they're perfect. Remember that, do your research, be diligent, and stay profitable. Thank you all for watching. I hope you enjoyed the video, and goodbye.